The new inflation data is in, and it looks like our core inflation just broke a brand new 40-year record high. And this comes at a time where everybody was hoping that inflation had already peaked and was coming down. Looks like that's not the case. Let me read you some of the data. So the actual CPI, which is our consumer price index, this is the broad inflation numbers month over month from August to September, was expected to grow by 0.2%. It actually grew by 0.4%. Over the last 12 months, from September of 2021 to September of 2022, inflation CPI was expected to grow by 8.1%, but it actually grew by 8.2%. And then the core CPI, this is where things get interesting. Core CPI is you take the broad CPI inflation numbers, and then you take out what they call the volatile things. So you take out energy, you take out food, and this is our core CPI. Core CPI was expected to rise by 6.5%, but it actually rose by 6.6%. And this is the highest 12-month core CPI numbers that we have seen since 1982. The reason why this is important is because the Federal Reserve Bank, who was in charge of setting interest rates, they are the entity working to fight inflation. They kept saying for the last year and a half that you don't need to worry about CPI, you need to worry about the core CPI. So the Federal Reserve Bank, when they make their interest rate decisions to fight inflation, they are more focused on core CPI than the actual CPI. And now core CPI is breaking new record highs, which means more fuel, more ammunition for the Federal Reserve Bank to raise interest rates more aggressively in order to fight inflation. Now, these things have consequences. I'll get to that in just a little bit and what you should be aware of and what you can be doing. But before I get into that, let me go a little bit deeper into the data, because it says that the advance in inflation was broad-based. What caused it? Shelter prices, food prices, medical care prices, all of these things contributed to high inflation. But what's interesting, remember, this is inflation data that we just got is up through September. One of the things that declined on this inflation data is gas prices. Now, if you look around you, you'll see the gas prices are pretty expensive. Well, these gas price rises happened in the last few weeks, especially in the last few weeks. So September overall had lower gas prices, which contributed to inflation not being as high as it could be. Next month, you can expect higher gas prices to impact inflation in a different way. Now, I do want to let you know that there is a global investor summit happening, and I am one of the keynote speakers. And if you do want to listen to me talk more deeply about inflation and the coming recession and everything going on in the economy, it's $97 to join. But because you are a Minority Mindset fan, you can join for free. So if you want to watch my keynote speech and join the Investor Summit, I've got the link for you down in the description below, because I'll be talking a lot about inflation. Now, this CPI report that we just got is the last one before the election. And we have midterm elections coming in November. And prior to that, on November 1st and November 2nd, the Federal Reserve Bank is going to be meeting to discuss how to fight inflation. And now that we have our jobs data report, which says that the job market is still relatively strong, and now that we have our inflation report, which says that inflation is extremely high, these two things are kind of like the perfect storm for the Federal Reserve Bank to now say we're going to continue to raise interest rates aggressively. And that's why when this inflation data first came out, the stock market immediately went downwards because, well, theoretically, high inflation is good news for the stock market. It isn't good news right now because what people are saying and what traders are doing is they're saying high inflation means a stronger fight against inflation. A stronger fight against inflation is bad news for the economy because higher interest rates hurt the economy. They hurt businesses. They hurt the housing market. They hurt stocks. And most people are pretty much expecting and know that now the Federal Reserve Bank is going to be forced to raise interest rates aggressively again in November. And while you have a lot of people hoping that the Fed will start cutting interest rates soon, the higher inflation is, the less likely it is to happen. So pay attention to all of that. Pay attention to how gas prices will affect the next inflation report. But let's dig a little bit deeper because CPI has some, what I like to call massaged data. And I talked about this a lot 9 months ago, back when CPI was really starting to grow. But what it said over the last 12 months was that rent and shelter costs both grew pretty aggressively. They grew by around 6.7% on an annual basis. So housing costs, according to the CPI data, grew by 6.7%. Now, if you look around you, you'll see that home prices and rent prices have grown way more than 6.7% over the last 12 months. And so how can the CPI say that rent costs and housing costs have only grown by less than 7%? Well, they don't actually look at housing costs. They don't actually look at rental costs. What they look at something called owner's equivalent rent, which means they do surveys of homeowners and ask them, if you were to rent your home, what would you rent your home for? And it's kind of a massaged number because most homeowners don't know what the fair market value of their rental prices is. And it doesn't give you a real depiction of the rent and housing costs that people have to pay. So the real CPI is actually significantly higher. The real inflation that people are actually paying is significantly higher than this reported number, but the reported number is already very high. Our core inflation is already breaking record highs. So just a little food for thought. And on the concept of food costs have also skyrocketed over the last 12 months. From September 2021 to 2022, food costs have grown by more than 11%, 11.2% from 1 year ago. And the good news is used car prices have also begun falling. Although new car prices are still growing, used car prices have finally begun to fall. We have 3 months now of used car prices falling. So that's kind of a rundown of what's going on in the new inflation report. And this brings me now to what does it mean for you? Because yeah, the Federal Reserve Bank is going to be meeting November 1st and November 2nd. And they're going to most likely, I mean, you can't say what the Fed does because you never really can predict what they do, but they're going to most likely raise interest rates aggressively in order to fight inflation. When you raise interest rates, that has an impact on many different parts of the economy. In the housing market, mortgage rates go up, which make it less attractive to buy a home. Mortgage rates have already passed 7% now for a 30-year fixed rate mortgage. We haven't seen 7% mortgages in a long time. And so you can expect the housing market to be impacted because now if mortgage rates hit 8% or 8 point some percent by the end of the year, well, that's gonna really affect the housing market. And if inventories continue to go up, because people start selling their homes or they can't sell their homes, well, eventually you're gonna see a bigger correction in home prices. Same with the stock market. Now as interest rates go up, well, all these corporations that have a lot of debt, because over the last few years, businesses, I'll talk about people in just a second, but corporations and businesses have loaded up on billions and billions and billions of dollars of debt. We have a corporate debt mountain, like the most corporate debt ever, because corporations were like, we can borrow money for 2 to 3%. Who's not going to do that? Well, a lot of these corporations don't get a fixed rate debt, don't get fixed rate mortgages like you do when you get a mortgage. And so in the coming years, when the interest rate readjusts, and now it's 2 or 3 times more, the interest rate is 2 to 3 times more than what it was when you originally got it, it's gonna become extremely expensive for businesses to continue servicing and paying these debts. There's a growing thing called zombie companies. You might wanna go to Google and search zombie companies, but essentially what this is these are companies that don't make enough money to service their debts. And there are hundreds of these zombie companies that are traded on the stock market. And this number has been growing because the cost of servicing debt has been growing so quickly. And eventually this is gonna trickle down to the actual bottom line for the companies, where now they're gonna have to make a decision. Either we're gonna have to sell the company, we're gonna have to go out and raise more money, or we're gonna have to declare bankruptcy. And over the coming 6, 9, 12 months, you're gonna see more of these things happen if interest rates continue to stay high, and if interest rates especially continue to go up. So that's one thing you wanna pay attention to. And the third thing is consumer debt. Because sure, if you have a 30-year fixed rate mortgage, higher interest rates don't affect you. However, the average down payment on a home right now is 6%. So you gotta think, if home prices fall by just 10%, you're gonna have a big chunk of America that's underwater on their homes. Not to mention that if mortgage rates continue to go up, people are not going to want to buy homes. And not to mention, we also have credit card debt and other consumer debt growing very quickly. Why is it growing so quickly? Because people need money in order to survive. The cost of everything is so expensive because of all the inflation that we're seeing, and so people have been borrowing money. Well, now your other debts, not your mortgage debts, but now your credit card debt, your home equity lines of credit, all these other debts are variable interest rates, which means as interest rates go up, the cost of servicing this debt goes up. And not to mention, I know there's a lot of stuff, our national debt. We have just passed $31 trillion of national debt. Our cost for the government to service this debt is now going up. In the coming 12 months, you're going to see a lot of our national debt readjust, meaning the interest rate that the government's going to have to pay is going to readjust. And that means the government's going to have a lot higher costs to pay this higher debt. And that is going to have a burden on our government. And you can start to see this debt pinch because we have like this debt crisis happening. We have all this debt and it has ballooned because of all the low interest rates over the last number of years. Now, interest rates are growing very quickly, and it looks like they're going to continue to be growing quickly with the latest inflation report. And so these things are all going to have consequences. Everybody keeps saying that we're not going to have a recession. President Biden just yesterday, along with Treasury Secretary Janet Yellen, came out and said, I don't see how we could have a recession. I don't see a recession. If we have a recession, it will be completely mild, nothing to worry about. Well, just understand we have a lot of debt issues, we have high inflation, and now to fight inflation is going to be painful. And the size of the correction has got to be proportional to the size of the bubble. And this is a very large bubble that we have built up in the last number of years. So these are things that you want to be aware of. I do talk about this, and my team covers this every day in Market Briefs, which is my free financial newsletter. So if you're an investor and you want to stay up to date on what's happening, when it's happening, you have to join Market Briefs. It's a completely free resource that I created to help keep you updated on what's happening into a fun, easy to read and witty email. So if you haven't joined Market Briefs yet, I'll also put that link for you down in the description below. Now, there were some really interesting things that happened in 2021, which contribute to the housing market slowdown in 2022. What are those things? Well, inflation. And not just inflation, but people's opinions on inflation. Because if you remember, in the beginning part of 2021, the Federal Reserve Bank came out and said that inflation is transitory.